So, there's a theory I want to share with you today that will make you question almost everything you thought you knew about money, America's power, and what is actually happening behind the scenes, away from the headlines and the Hollywood story the media sells you every day. Because there are two stories occurring simultaneously, the one you are being told and the one that is actually happening. And the gap between them changes how you see the news, markets, and your own money sitting in your bank account right now. This theory connects dots most people have never tried to connect, involving China, gold, the death of the dollar as we know it, and a weapon so powerful it doesn't fire a single bullet or need an army, but just needs time. A weapon that has already been activated and is running while most Americans have no idea it exists. So, to understand this weapon and why China activating it now is such a massive deal, we must go back to the very foundation of the system we live inside. Because you cannot understand where we are going unless you understand where we came from and why the system was built the way it was. Starting in 1944, when World War II was not over yet, but the Allied powers knew they would win and that the global economy would need rebuilding from scratch. Since Europe and Japan were destroyed and the old world order, including the British Empire and the gold standard, was gone. So delegates from 44 nations met at Bretton Woods, New Hampshire, and decided the US dollar would become the world's reserve currency, pegged to gold at $35 per ounce, making America the most powerful nation on earth. Until fast forwarding to 1971, when the Vietnam War and domestic spending caused America to print more dollars than it had gold, leading France to call America's bluff and demand gold exchanges, forcing President Nixon to announce the dollar would no longer be convertible to gold, ending the Bretton Woods Agreement and backing the dollar only by trust, which created an immediate crisis until Henry Kissinger flew to Saudi Arabia to make a secret deal where Saudi Arabia agreed to sell oil exclusively in US dollars, giving birth to the petrodollar. So every country needing oil had to hold dollars, creating massive global demand, allowing America to print money and buy real goods from other countries while enjoying an exorbitant privilege to run deficits, borrow cheaply, and weaponize the dollar against enemies. A privilege America used aggressively, causing resentment from Russia, Iran, Venezuela, and especially China, which understood that as long as the dollar ruled, America held an undefeatable financial weapon over them. So China decided long ago to build its own weapon to fight back, and that weapon is gold. Now, here is where you must pay close attention because what follows is not a conspiracy theory but documented fact and public record happening in slow motion for over a decade while mainstream media ignores it. As China has been buying gold on an incomprehensible scale, being the world's largest producer, yet keeping almost all of it instead of selling it, while aggressively buying more on global markets, with the People's Bank of China reporting monthly purchases that analysts believe are understated because China does not want to tip its hand before its endgame is complete. So, to understand that endgame, you must grasp the $100 trillion trap, where the US national debt has crossed $36 trillion, growing by $1 trillion every 100 days, with interest payments now exceeding $1 trillion per year surpassing the entire military budget. And when adding unfunded liabilities like Social Security and Medicare, the total obligations explode to between 100 and 200 trillion dollars, a number mathematically impossible to repay through traditional means since the tax base and economy cannot grow fast enough, meaning the debt can only be managed, inflated away, or restructured, which requires someone to take a loss. And China, watching this number grow for decades while holding $750 billion to $1 trillion in US Treasury bonds, knows that if the dollar loses value, they lose purchasing power. So they have every incentive to reduce dollar exposure and replace it with an asset that holds value when the dollar weakens, which throughout all human history, across every civilization and empire that has risen and fallen, is gold, connecting directly to the staggering flow of physical gold leaving the United States right now, not as digital contracts, but as actual bars and coins shipped overseas, making gold the single largest US export by dollar value, bigger than soybeans, pharmaceuticals, or oil, moving primarily to Switzerland for refining and then to China, or sometimes directly to China, which matters because historical patterns show the country exporting gold is losing power while the country importing it is gaining power. Just as gold flowed from Spain to Amsterdam and London as Spain declined, or from London to New York as Britain borrowed to fight world wars, until America held half the world's gold by 1945, securing the dollar's reserve status, proving the country with the gold writes the rules. And right now, in 2025 and 2026, America is exporting gold at unprecedented rates while China imports it at unprecedented rates, marking the fingerprints of a power transition. Let me bring this back to the present moment and the Strait of Hormuz, which is a critical choke point where 20% of the world's oil and liquid natural gas passes and which has been disrupted following military confrontations involving the US, Israel, and Iran earlier this year, despite the official story claiming a peace deal is coming and everything will return to normal because the data tells a different story, showing global oil inventories being drawn down steadily to compensate for lost supply, with Bloomberg reporting operational stress levels by June and minimum floor levels needed for refineries and pipelines potentially reached by September, while Jeff Curry from Goldman Sachs notes parts of Europe and Asia are already in shortage, not just deficit, meaning inventory is genuinely gone. Yet Morgan Stanley research suggests no demand destruction until oil hits $140 per barrel, raising the question of why prices remain low if supply is disrupted, and the uncomfortable answer is that someone is managing it using financial instruments and media messaging to suppress prices artificially to buy time and prevent markets from pricing in the full reality, which would trigger a massive inflation spike, force aggressive Fed rate hikes, crush stock and bond markets, and expose the fragility of America's $36 trillion debt load, potentially causing a crisis, making 2008 look like a warm-up. So central planners and officials need to keep things calm on the surface while working on fundamental solutions underneath, managing the narrative that Iran is the bad guy and the strait will reopen soon. But underneath this managed narrative, I believe the closed strait is not just a side effect, but a strategic weapon for China and Russia, used deliberately as leverage to force negotiations about something bigger than Iran's nuclear program, since Iran benefits from removed pressure, Russia benefits from higher energy prices funding its military, and China benefits because the energy crisis creates urgency for the West to resolve it. And China, as Iran's largest trading partner buying its oil, keeps the strait closed,
giving China a lever to turn to buy a seat at the table for global monetary restructuring. And since both China and Russia could prevent Iran from getting nukes if they wanted, but haven't, because they need the closed strait and economic pressure on the West to create the urgency that brings powerful American CEOs like Elon Musk, Tim Cook, Jensen Huang, and Larry Fink on a plane to Beijing for a deal that officially is about tariffs, but theoretically is about the architecture of a new global monetary system, a new Bretton Woods, and a new Plaza Accord. To understand what may be happening now, we must explain the original Plaza Accord of 1985, when the US faced a too strong dollar, ballooning trade deficit, and uncompetitive manufacturers. So the Reagan administration secretly met with France, West Germany, Japan, and the UK at the Plaza Hotel in New York to make a deal where other countries intervened to push the dollar down and their currencies up, particularly the Japanese yen, which doubled in value, allowing Japanese companies favorable access to the American market to build factories and sell cars, which initially looked like a win, but devastated Japan's export economy, causing exports to collapse and the economy to seize up, leading Japan to flood its economy with cheap money, creating a spectacular asset bubble in real estate and stocks, where land under the Imperial Palace was worth more than all California real estate combined, until the bubble burst in 1990, starting Japan's lost decades from which it never fully recovered, essentially ending Japan's challenge to American dominance, a lesson China watched carefully and studied, leading to a non-negotiable strategic commitment that China would never allow itself to be Plaza Accorded or accept sudden yuan revaluation against the dollar. But since the underlying problems of trade imbalances, dollars overvaluation, and unsustainable deficits are worse now than in 1985, with larger deficits, hollowed manufacturing, and incomprehensible debt. A solution is still needed. So if China won't accept direct yuan revaluation, the answer according to this theory is gold, where instead of revaluing the yuan, both sides allow the dollar to weaken against gold, making gold the escape valve, an asset absorbing the repricing as both countries let gold rise dramatically in dollar terms, creating a beautiful symmetry where the US holds 8,133 metric tons of gold booked at the 1973 price of $42.22 per ounce, while the market price is over $3,000, meaning updating the valuation would dramatically improve the US balance sheet overnight, making the debt burden manageable without explicit default or obvious inflationary printing, while China, holding enormous understated reserves, sees its wealth explode without yuan appreciation, protecting its export economy and gaining legitimacy as a co-architect of the new monetary order in exchange for investing approximately $1 trillion into US manufacturing, building factories and infrastructure on American soil, employing workers, just as Japanese automakers did after the original accord, but at a much larger scale, allowing Trump to claim he brought back jobs and China to get tariff relief and market access. So both sides claim victory and step back from conflict, while underneath it, all the repricing of gold moves quietly like a tectonic plate shift, absorbing the adjustment without visible chaos. Here is why I think this is more than a theory, and why the market is already pricing it in before any announcement, because since late March, something strange has happened in currency markets where the US dollar has been consistently declining against the Chinese yuan, persistently going against the logic of the official narrative that America is pressuring China with tariffs and restrictions which should weaken the yuan and cause capital flight to dollar assets. Yet the opposite is happening, with the yuan getting stronger, while simultaneously government bond yields globally show China's yields going down, indicating high investor trust and demand for Chinese debt, while US and other nations' yields go up, indicating worry and higher risk premiums, which is the exact opposite of what should happen if America's trade war was hurting China. And alongside this, gold has been on a historic sustained multi-month surge to all-time records, not just as an inflation hedge, but as a monetary metal rising when smart money like institutional investors, central banks, and sovereign wealth funds lose confidence in the current system and conclude Something fundamental is changing, so gold rises because smart money knows the global monetary order is shifting and the fingerprints of a deal are visible in the data with the dollar weakening against the yuan. Chinese bond yields falling, gold surging, and physical gold flowing from America to China, which are not random points but early signals of fundamental restructuring, meaning ultimately all this geopolitics and history only matters in the context of what it means for your money. And the honest answer is that if this theory is even partially correct, the implications are enormous and uncomfortable because the core mechanism is a sustained deliberate weakening of the dollar's purchasing power against real assets like gold, commodities, businesses, and real estate. So the dollar buys less, and essentials like food, energy, housing, and healthcare cost more over time, which is inflation. And inflation here is not an accident or mistake, but the whole mechanism of the deal, because the dirty secret of modern finance is that inflation is how governments make unpayable debt payable again, since America's $36 trillion debt cannot be repaid in real terms. But with enough inflation over years, the real value shrinks as dollars borrowed in 2020 are repaid in 2035 with significantly less value, making the debt burden manageable through a transfer of wealth from creditors to debtors, savers to asset owners, and cash holders to real thing holders.
The people who will be okay in this environment are those who understand what is happening and position themselves accordingly, while those who won't be okay are those operating under old assumptions that savings accounts are safe, dollar assets hold value, and the system is stable as parents said, but it isn't. And evidence is everywhere if you know how to read it. Though let me be clear that all this is a highly informed theory built on real data and historical patterns, but a theory nonetheless. So the deal might not get done. The Strait of Hormuz might reopen tomorrow, sending oil back to $70 and collapsing the thesis. Gold flows might have unrelated reasons, or China's motivation might be purely defensive rather than coordinated restructuring. And these are possibilities I hold in mind. But what I notice is that whether this specific theory is exactly right or not, whether it is a gold structured Plaza Accord 2.0 or restructuring via another mechanism, the broad directional conclusion seems robust across multiple scenarios. Because the dollar is likely to weaken over time, inflation likely to remain elevated, the debt burden unlikely resolved by fiscal discipline alone, and assets preserving and growing wealth in this environment are the scarce real ones, not paper or cash or printable ones, including gold, real estate, productive businesses, and scarce digital assets like Bitcoin, sharing gold's fixed supply characteristic in a world of unlimited money printing. So the specific path matters less than the destination, which across scenarios appears to be a world where the dollar buys less, cash is a losing position, and the divide between asset owners and non owners grows wider and harder to bridge, leaving you to ask honestly which side of that divide you are on right now, and more importantly, what you are doing about it. Since this story is not over with the deal, probably not finalized, the oil crisis not peaked, the Federal Reserve in transition, and enormous chapters yet to be written, which I will break down as they develop. But for now, these are the fingerprints, patterns, and what the data whispers if you know how to listen. I hope you found this useful, and if you want to go deeper to see the specific assets I am personally holding, what I think about this market in real time, and exactly what I am doing with my own money in response to everything we discussed, that content lives in the premium member section with the link below. Because your support there makes it possible for me to keep doing this work with fewer sponsors and more freedom to tell you what I actually think. So please hit the like button if this was valuable, subscribe if you haven't already, and I will see you next week. to take care of yourself and take care of your money before saying bye for now as we continue to watch these developments unfold in real time. Knowing that the shifts happening beneath the surface of our global financial system are far more profound than the daily news cycle suggests, and that understanding these deep currents is the only way to navigate the coming years with your wealth intact rather than eroded by forces you did not see coming or understand until it was too late. So stay vigilant, keep learning, and remember that in times of great monetary transition, knowledge is not just power but survival, ensuring that you do not become a victim of the great wealth transfer happening right now from the unaware to the prepared, from the holders of trading paper promises to the owners of enduring real value, and from those trusting in broken systems to those building their own foundations on the bedrock of scarcity and truth, which is the ultimate lesson of this entire analysis and the reason why we dive so deep into these topics together on this channel to empower you with the insights needed to thrive rather than just survive in the new world order taking shape before our very eyes.